Good morning, everyone. Dear Minister, dear Governor, dear members of academia and students, and everyone watching online. Welcome to today's seminar titled Macroeconomic Challenges in Lithuania, Strengthening Competitiveness and Building Resilience, organized by the International Monetary Fund and the Bank of Lithuania, and hosted by the Institute of International Relations and Political Science at Vilnius University. My name is Simonas. I am part of the team at the bank working on the IMF issues, and I will be guiding you through the event today. Please note that the first part of the seminar, the first presentation and the panel, is being broadcast live on the web, and also there's a photographer that you can happily pose to if you feel like it. So this seminar is taking place within the context of the IMF's Article 4 mission to Lithuania, led by the mission chief, Mr. Borja Gracia. The purpose of the seminar is to disseminate and discuss with the broader audience the research done not only by the IMF team within the context of the mission, but also by the researchers at the Bank of Lithuania. And we are organizing the seminar for a second year in a row now, so it is becoming a nice tradition already. Last year, the event took place at the Faculty of Economics and Business Administration. This year, we are at the Institute of International Relations and Political Science. And I know that this is not the first time that Borja is here. He delivered a public lecture here in 2022. And let me just say that we are very happy to have Borja and his colleagues back here at Vilnius University. And we also feel extremely grateful to the institute that we are currently in for hosting us, for providing the space and allowing the IMF and the Bank of Lithuania engage broader academic audiences and students. In line with the topics analyzed by the IMF team in this consultation cycle, this year the seminar focuses on the issues of competitiveness, productivity, as well as fiscal policy. The seminar will feature a high-level panel discussion on Lithuania's external competitiveness, with Finance Minister Gintarė Skaistė, who has kindly agreed to join the seminar, Governor Gediminas Šimkus, and the mission chief. We will also have three, as you may have seen in the program, three very interesting research presentations. But before all that, we will have an introductory presentation by Borja Gracia on the current state of the economy in Lithuania and the world. Let me just say that this is Borja's last mission, or I would like to say that this is Borja's last dance. And if you know the Netflix documentary in this title, I'm using it purely because Borja, over the years, I think it's since end 2017, has indeed and truly become the Michael Jordan of economic advisors to Lithuania. So without further ado, Borja, the stage is yours.
Thank you very much, Simonas. I guess it shows, your last remark shows that in Lithuania is basketball rather than football. I would have preferred the Zidane of the but that's a personal preference. Now, thank you very much. It's an honor to be here. The presentation I will give is structured in three parts. Is it working? Yeah. So the first part will go over, I will cover the global outlook, then I will focus on Lithuania, and then I will give a preview of the two topics of research that will be presented later on expenditure pressures and on competitiveness. So let me start with the global outlook. So the bottom line is, after a significant amount of shocks in the last 4 years, starting with COVID, supply chain disruptions after COVID, energy crisis after Russia's invasion of Ukraine that led to high inflation, a coordinated monetary tightening across the world, everybody 2 years ago, a year and a half ago, was talking about the stagflation, and that was in everybody's mind. No growth and inflation. Well, the world economy in the last few years has actually continued to grow during this disinflationary period of the last year and a half, and that's a remarkable achievement. And as you can see here, it's not just been low or emerging economies, but also advanced economies at a lower pace, but growth has been kept also in those, even during the disinflationary period of tighter monetary policy. Why has this been the case? Well, there have been some favorable demand developments. In particular, private consumption has been supportive of growth during this period, and that has largely been the result of tight labor markets across the world. If you look at Europe, the euro area at the right, this is still the case, but less so. Two things to highlight here. One is the impact of the energy shock in Europe was greater, definitely greater than in the US, where energy prices did not increase near as much. And so the contrafactual is we were expecting the impact to be even larger. So the fact that still there was some growth and some growth in private consumption, it's important. Government spending has also been larger and supported growth more than we expected 2 years ago coming out of COVID. And on the right, you can see that there was also a factor that supported private consumption, which was that coming out, I mean, during COVID, there was an increase in the savings rate across the world by households, and part of the undoing of that increase in savings rate has also supported growth. More moderate in Europe, where also the increase in the savings rate was a bit less moderate, is the yellow line in the euro area on the right. But all these factors on the demand side have supported growth and contributed to that development. But there have also been some favorable supply developments. First, labor markets have behaved better than expected, particularly labor force. In some countries, migration has been important. In advanced economies and some other countries, actually the foreign-born population growth has been more than the domestic-born, and that has supported labor force the increase in the labor force, but also labor force participation has been strong. That has helped. On the supply side, all those bottlenecks that occur after COVID in terms of, well, you have there the global supply chain pressure index and the world container index that worsened significantly in the end of 2020, especially in 2021. All those factors corrected. It's true that the issues in the Red Sea have reversed partially that trend, but relative to the peaks during the post-COVID period and relative to even historical average, those increases have not been as significant. So those are still not factors that will be a significant headwind if no further shocks happen. Further, the increase in energy prices was also reversed, so it proved to be largely temporary, in part because the production of oil and natural gas increased after the shock more than or faster than it was expected, and that was largely driven by the United States on both gas and oil, and that has also helped the correction in energy prices to be very dramatic and supported activity. So finally, what has happened to inflation? Well, and this is something that probably I will show also in Lithuania, but the pass-through of energy price increases to core inflation happened relatively fast. And the same, it's true when energy prices started coming down. So the large increase has proven not to be as persistent. And why the persistency didn't happen even though inflation in many countries increased significantly? Well, in part because, yes, near-term inflation expectation, the red line for advanced economies and the blue line, dotted line, not dotted line, the straight line for emergings, increased significantly with inflation as expected, but once inflation started to come down, near-term inflation expectations also started to come down quite significantly and are converging towards the long-term targets, the inflation targets. And at the same time, long-term inflation expectations never really deviated from target. So either banks' monetary policy was the right one, or the credibility of central banks is big. In any case, expectations never, long-term inflation expectations never de-anchor. That helped the correction in near-term inflation expectations. and that help reduce the potential risk of sustainable higher inflation rates going forward that we fear only a year ago. So all these factors have contributed to the global outlook. Now, I'm not going to get into all the numbers, but these are our forecasts, our recent developments until 2021, but our forecast for the near term. Growth will continue. The adjustment, the disinflationary process will finalize in the next year or two in countries, but moving inflation back to target. But growth in the near term, we project for the world to be just above 3%. That is quite lower than growth in the 2 decades prior to COVID, which was just below 4%. The WIO looks that we published in April looks at the underlying reasons in this dynamic and in our projections, and half of it is coming from TFP, and I'm not going to get into the details, but this is particularly the case for emerging economies, the slowdown in growth going forward relative to the past, and suggests that the global income convergence that we had observed for decades now, and it was quite strong, if our projections are correct, will slow down going forward. Now, I'm not going also to get into a lot of the details on risk, but in general, which will apply also to Europe, as you will see in a second, we see the balance of risk to have, the balance of risk to have decreased relative to last year. So we see downward risk, but upside risk also dominated, and especially some risk that we identified last year, particularly inflationary risk, inflation to remain persistently above target, to have fallen significantly. So these are the numbers for most of the world, including the euro area. I can go into details about some of this if you want later. Let me move to Europe. The outlook, in terms of qualitatively the story is similar, but as you saw before, the recovery in Europe, it's more gradual. Whereas for the world, we are already projecting 3% growth the next 3 years already, this year and the next 2. In Europe, that is going to take, the recovery is more gradual this year and particularly next year. Inflation is also coming down, and we expect that basically across Europe, advanced Europe, but also emerging Europe, inflation will get back to target under our baseline between next year and the following year. A bit later for emerging economies, that inflation is proving a bit more persistent and slightly higher, but still. And the story is basically the same. In Europe, strong labor markets are supporting real income, especially lately when inflation has come down and wages in real terms have increased. So you can see that services particularly and the composite index are picking up faster. Manufacturing, so services particularly are recovering quite strongly. Manufacturing is lagging behind, but there are some signs that it's already recovering. So that's the outlook we have for Europe. Now, for this outlook, so it's really an outlook of a soft landing. So the disinflation is taking place and growth is gradually picking up. For that to happen, we have some assumptions. First, that the tightness of the labor market is a bit, and there are some indication that it's already, like for example, the vacancies to unemployment that was coming out of COVID was high, both in advanced and emerging Europe. It's already easing. But unemployment rates remain, this is a historical unemployment rate from the 2000. The dot line is the current unemployment and the other is the spread in the last 20 years. Unemployment rates remain very low. But the labor utilization, and we will argue that that's an important factor that has happened in Lithuania, it's relatively low. So hours work or per employee fell during COVID and it hasn't recovered to pre-COVID. So there are mixed signals, but at least there seems to be some easing on the labor market that suggests that this risk of wage inflation spiral, because of a very tight labor market conditions, it should not happen. And at the same time, the labor market is tight enough to support, especially now that inflation is below wage growth, to support the recovery in disposable income, particularly in CC, but now, over the last few quarters, also in advanced economy, to support growth in consumption. At the same time, we are projecting that the fiscal, in general in Europe, the fiscal positions are tightening after significant fiscal support during COVID, but also during the energy crisis. The fiscal governments need to rebuild fiscal buffers, and we are projecting that it's already happening this year. In our assessment, not as fast as it should, but still. So for the recovery to take place as we saw, private consumption compensates, the private consumption increase compensates the drag on demand that comes from this fiscal rebuilding of buffers. And investment, well, investment we expect it to be relatively flat in advanced Europe and a bit more supportive in emerging Europe, as you can see on the left, but still relatively, so especially for advanced Europe, relatively moderate contribution to growth. So here I just want to stress again, this is our projection on what are going to be the contributions, mostly private consumption, recovery in investment, gradual, but happening, particularly in CC, not so much in advanced Europe, in the middle graph. Wage growth should moderate with inflation. And, but as you can see on the right, inflation projections are for the euro area to recover, or advanced euro to go back to target. These are deviations from target. Sooner, maybe half of next year, the euro area in particular will reach the 2% mandate, the ECB's mandate of stable below, close but below 2%. And it will take a bit more time in CC, where the inflation shock was also larger. So what about Lithuania? Basically, the story is similar. So we expect the recovery in real earnings. So real wages in Lithuania turned positive in August last year, and they are increasingly so because nominal wages are moderating, but really much less than the decrease in inflation. That is already supporting consumption, and there are a lot of that started in the last quarter, and so we will know, or we should know now, the new Q1 data from the statistical office, but the expectation is that private consumption will gain pace during the year, supported by what is still a tight labor market. And so you can see that here, these are high-frequency indicators, and all indicate that there should be a recovery, and that the recovery in industry will happen, but more gradual. Because as we've just seen, the euro area, especially the euro area, recovery is more gradual. So you have a recovery that it's first is being driven by domestic demand, and then to domestic demand along the year you will have a gradual but still recovery in external demand, particularly the euro area. So both should help Lithuania's recovery, gaining pace as the year goes. Now on inflation, so this is just to explain, so we saw a very dramatic increase in inflation. We made big, in last year consultation, we made a big thing of potential inflationary risks. I remember the minister was not very happy with our assessment, or didn't agree fully with our assessment, and maybe she was right and we were slightly wrong in emphasizing so much these risks that have not materialized. So what you observe is the increase in inflation, headline inflation on the left was very significant, twice the euro area. But as I said before, and it happened in Lithuania as well, you have core inflation in the middle. Basically, the pass-through from energy prices to core inflation happened very fast. And the same is true when energy prices came down. And that has been the main driver of core inflation. Now, services, this is now the big question mark, is whether inflation in services will be more persistent and could prevent or could put some some floor on the degree of disinflation. Now, this is comparing the blue line in the right chart is comparing the current disinflationary episode in services to the previous high inflationary episode during the GFC. And you saw that at that time, the blue line, the disinflation in services continued for longer than we have just seen. Now it's stabilized in Lithuania, inflation in services in the last couple of months. But that's also expected. The GFC delivered, the output gap became very negative. The labor market was very weak. Nominal wages were negative all this period. So the economy was significantly, affected, and activity was very weak. Here, as we just mentioned, the labor market has remained tight. Real wages are now positive, and the output gap is not near as negative as it was during the GFC. So the persistency in services inflation is not surprising and should not represent a significant risk or inflationary risk going forward. Let me just mention also, I mean, since I said that last year we made a big thing about inflation risks, what was the risk we had in mind? The risk we had in mind was this inflation wage spiral, that higher inflation fits into wages and higher wages fits into inflation. And that's basically what has happened in emerging Europe. This is the price level, is the straight line, and the dotted line is nominal wages per hour. So in Eastern Europe, the formation of wage expectation has a lot of a backwards component. So you try to compensate for what happened in the last period, and so there is a lot of persistency in the wage and inflation. And this is what you saw. Once prices started to increase in 2022, at the end of 2021, wages followed prices. And so in Eastern Europe, you have that the dotted line was below the red line very little, and not so real wages were never really very negative. And not only that, but this backward component of wage formation, you can see what is doing in the last few quarters, which is that wages have continued to increase at the same rate, even when inflation has moderated significantly. And so you have now very high real wages in Eastern Europe. In advanced Europe, the opposite is true. Wages are much more sticky, they are much more forward-looking, and that's where the long-term inflation expectations played an important role. So the inflation surprise resulted in a real negative wages, and wages very gradually have increased and not near the increase in inflation. Now, what happened in Lithuania? It was basically a mix of the two. Lithuania came out of the COVID in a very strong position. When we were here in 2021, well, I think that was online, but when we did the 2021 report, we thought the economy was overheating before all the war and the energy shocks. So there was already a demand component of inflationary pressures that was manifesting, that was not the case in other euro area countries, and inflation started to follow the increase in prices. Real wages were already high, but they were not, they didn't turn negative. Now, after the energy price increases in 2022, fortunately, the behavior was closer to advanced Europe rather than Eastern Europe. So it seems that wage formation, or the backward component of wage formation was less important than in Eastern Europe and more similar to advanced Europe. And that resulted in a significant real negative wages. And obviously, that's why the last 2 years have been very tough for Lithuania. It's one of the reasons, because real disposable income has been affected negatively. Until last August, where at the end of the period, you see the dotted line started, the gap between the dotted and the straight line started to close again. Real wages started to be positive again. So basically what we expect is a recovery that is gaining pace. Growth, we are going to finalize our new projections, but growth, we expect it to be between 2.5 this year. Inflation has surprised us on the downside, so the disinflation, it's quite strong, and probably our new inflation projections for this year will be around, on average, 1% maybe a bit higher, maybe a bit lower. But the recovery is definitely taking increasing, pace as we move along. As I said, there are two areas that we are going to discuss later. One is on competitiveness in Lithuania. I will give a small preview of Sayoa's work, and then of coming spending pressures, mostly related to aging, but not just. So let me start with competitiveness. And just to get to explain what has happened lately. So the terms of trade, price of exports relative to the price of imports, have been, for the Baltics in general, quite stable, and even the euro area in general, for a long period of time, at least in the last 20 years, 19 years. Has been fluctuating, but really within a relatively narrow range. And if you look at the other two Baltics, if anything, even with the energy shock of the last 2 years, it was, if anything, improving. This is annual data, so monthly data shows more variability, but the performance in Lithuania has been dramatically different. And Lithuania has had the worst terms of trade shock in recent history, or in recent memory, and the worst in the euro area. That was the year when energy prices increased. Again, if you look at monthly data, this is more or less at 10%. It almost reached 20%. And it's only partially corrected when you look at this. And this is very important because at the end, the price of exports over imports, the terms of trade, tells you it's an indication of negative terms of trade means that you can get less of your less imports with your exports. That as a country, you are more poor in a way, no? You need more to produce more to get the same amount of imports. So this has significant implications. As we saw before, the real disposable income was negatively affected. Let's step back, however. So this is the real GDP growth since independence, basically, quarterly. And you saw you first had a very spectacular growth at the beginning of the sample with some bumps along the road. But once you started growing in the late 90s, growth was around 6.5% in real terms for a lot of time. But this, now we know, was not a sustainable growth, especially in the last few years after the global financial crisis. Imbalances grew dramatically, and you had a very sharp correction in levels and in growth. So real GDP fell significantly during the GFC for a short period of time, but very dramatically. And growth almost halved from 6.5 to 3.6, around 3.6. But however, this new growth path was sustainable. It was sustainable over 15, 20 years, and it was sustainable without reemergence of imbalances, and supported on an increasingly competitive economy that was gaining market share. So it was a completely different growth, lower but more sustainable than the pre-GFC growth. Then it came COVID, and the question mark was what was going to be the long-term impact of COVID? Well, by 2021, basically Lithuania had got back to the pre-COVID trend, not just the growth levels, which only fell on average, including the drop during the quarters of the lockdowns, to 3.2 from 3.6. So you were back at the same growth rate and the trend that you had pre-COVID. So we thought that the long-term impact of COVID was going to be almost negligible. But then the energy shock has been quite different. And in the last 2 years, growth has been really flat. And still, there is a question mark then on what is the impact of these last 2 years with these very negative terms of trade shock on the Lithuanian economy. So let me focus on a couple of things. And just for just the final point on getting some perspective. In 2009, after the GFC, if you look at the euro area, your GDP per capita, controlling for price level differences, was second to last, next to Latvia, very close to Latvia, and at around 40% of the average of the euro area. In post-COVID, you were 80%, you double your, and you take over, you left behind, let's put it like that, all the other Baltics significantly, particularly Estonia, but also countries like Portugal, Spain. So this is a very successful performance. So let's just keep that in mind when we talk about the challenges ahead, because there is also a long way that has been walked through. The last 2 years, basically, I don't know if you noticed, but this is 2021, this is 2023. So the last 2 years, you haven't gained anything, but it's true of every other country. There's been really, the shock has been a big shock for all of Europe. But let's get deeper into why this shock was so different between Latvia, Estonia, and Lithuania. This is the terms of trade shock for 2 periods, the 5 years before COVID and the last 2 years. As we were saying, there has been a significant deterioration in the terms of trade of Lithuania, but not in Latvia and Estonia. But this is not the full picture. Really, the deterioration came from goods, where, the deterioration was double the total terms of trade. And this is where the difference with Estonia and Latvia came. So what does this mean? It means that in Lithuania, the price of imports, the increase in energy prices and other prices, was not passed through to the price of exports, whereas in Estonia and Latvia it was. And as we will see, this helps explain why Lithuania was able to preserve market share at a very difficult time, more than particularly Estonia. In services, the story is quite different. if anything, the terms of trade in the last 2 years in Lithuania improved, as so did in Estonia, and a small deterioration in Latvia. And this also helps explain the behavior of services. Last year, you reached a historical high trade surplus on services, around 10% of GDP, which is quite remarkable. And again, let's not forget that the impact of the terms of trade, just a reminder, was the largest in the euro area. Second challenge is that in the last 2 years, we've seen a negative labor productivity, particularly in tradable goods, but also non-tradable services. And this obviously makes so you had deteriorated terms of trade, negative productivity growth, and therefore the questions about its competitiveness going to suffer going forward. The positive spot is that that's not true of services, tradable services, and probably helps explain the surplus, the historic surplus in services that I was just mentioning. Part of the story, and I can get into details later if you want, is that employment has been positive even when the economy was weakening last year, which was very surprising. It's also true that hours work fell during COVID more than employment, and there was a gap that it still remains. So hours work have not recovered to pre-COVID levels in Lithuania, which means that basically if you look at hours work per employee or per person, they fall dramatically in 2020. They recover a bit when the lockdowns were over, but they are still significantly below levels pre-COVID. So we believe there is some labor hoarding, that employment has been preserved even when output was falling, and I can, again, get into details later on that if you want, that suggests that a significant component of the negative labor productivity growth over the last 2 years could be cyclical. And with the recovery underway, it should be, or it could be reversed. So what was the bottom line? That there has been a loss in market shares. If you look at, this is only goods. If we look at goods, Lithuania has lost 7% of the market shares from the peak of 21 Q3 to the end of last year. This is similar to Latvia, that the loss was 6%. But look at Estonia, it's 23% market loss over the same period. Now, we can dig deeper into this and try to see, okay, you can lose market shares because the markets, your markets, are disproportionately affected. And if you remember at the beginning of the presentation, we saw that the euro area is really, the growth in euro area is weaker than in the US, than in East Asia. So your markets are the euro area and the EU. So there is that demand effect. You are exporting to markets that have low demand, and therefore, as a share of the world trade, you are falling. And this is basically explains 2/3 of the drop in market shares, that your export markets are going over a weaker than the rest of the world situation. And in Estonia, in Latvia, it basically explained the whole market share decline, but only around 10% of the market share decline in Estonia, which is quite remarkable. And you can also look at the structural factor, competitiveness factors. That explains, in the case of Lithuania, 1/3, basically, around 1/3 of the drop in market shares, but 80%, around 80% versus in the case of or 70% in the case of Estonia. And if anything, in Latvia, it seems competitive factors have actually improved, not decreased. And then there is an interactive or interaction effect that I think Sayoa will get into the details in her presentation. But basically, the story is, yes, there has been a loss in market shares. It's largely driven by demand factors in the markets you are exporting. And more importantly, that's the same, so that's the -7%. It's that if you take out Russia, basically there has been no market share loss. But on the other hand, the market share loss in Russia should be considered permanent, at least for the near term. That's not coming back. But so Russia is due to sanctions, so it's not really due to your competitiveness loss or not loss of competitiveness. And if you take out Russia, the behavior, first, the positive thing is your export shares are quite diversified in terms of the countries, and the experience is mixed. But once you take out Russia, actually your export shares were held quite nicely during this period of negative terms of trade shock and negative productivity, labor productivity. And this is on top of a significant increase in market shares in the period. We choose 2015 because it was after Russia's annexation of Ukraine that had an impact of, at the time, the sanctions at the time had an impact on your export shares. So this was from after the loss of export shares in Russia and Belarus at the time. But in the period 2015-19, before COVID, you had in goods, market share increase of 24%, 3/4 of which were, we think, driven by competitiveness gains. So this is quite remarkable. And in services, I hinted already that the terms of trade were positive, productivity was increasing even in the last 2 years. So on the right, you have the gains in the last 2 years have been above 30%, and they deliver the trade surplus that I was talking about. That was on top of almost 60% increase in market shares in the 5 years pre-COVID. So the services performance has been quite remarkable in the case of Lithuania. So with this, and Sayo has many more things to add to this, and probably in the panel we will get into some of those. Let me move to spending pressures. And I know I'm running out of time. Sorry, apologies for that. So there are some short-term spending pressures related to defense and interest payments, but there are other spending pressures that are adding up. So you are already feeling spending pressures from defense and interest payment, and those will only be adding to others related to aging, particularly in pension, healthcare, and long-term care, education, and on top of that, also green transition that requires significant amount of investment. So let me just give you our bottom line, and Serhan will go in, again, more detail over this after lunch. But our best estimate is that spending pressures can be from 5% to 10% over the medium term. Now, this is subject to significant uncertainty. The longer you try to project, the greater the uncertainty. Some of these are more certain than others, but still, the message we want to transmit is that, and this is not unique for Lithuania, but this is not a marginal problem that can be fixed in a quick, easy way, adjusting things at the margin. This is a significant problem that is going to be increasingly, steadily, but unavoidable going forward. And these are, using the aging report, the recent version, the 2024 version, these are the comparable numbers for the Euro area and the EU. So these spending pressures were already coming. These are two excerpts from our 2018 and 19 report. We already observed that some spending pressures, mostly on social spending, that has been increasing over time, had squeezed the discretionary part of the budget, and that there is so much you can do doing that. Eventually, you cannot do that anymore, and that we are, I think the budget in Lithuania is reaching the point where there is no more discretionary spending to eat from to address some of those spending pressures. And in particular, the pension system, there was a reform in 2018 that significantly improved the sustainability of the system. But the cost was that the replacement ratio, the ratio of pensions to wages at the time of retirement, was declining from an already relatively low level. So the accrued pension entitlements, which means what the pension system owes if suddenly today they had to pay all commitments from people that provided contributions, was steadily declining. But in the last 3 years, the pension indexation formula, the pensions have increased beyond the pension indexation formula, and therefore this has been reversed. In 2020, it's a bit of a one-off because the economy was very weak, so in percent of GDP, it's a bit distorted. But in the latest number we have for 2021 is that it increased 60 percentage points of GDP. And the aging report, the number I was showing before, that pension spending, it's 3% in the medium term. It's 3 times what the pension report aging report found only 3 years ago. Because demographic assumptions are worse in the long term, not in the short term, that are better, but in the long term, and because of these increases beyond the indexation formula. So the problem is very significant, and so, but what are the goals? So we are suggesting that it needs a comprehensive solution, but what are the goals that we think are important to keep in mind? Obviously, the problem is to accommodate the spending pressures that are unavoidable, but the goal is also to do it in a way that preserves stability, macroeconomic stability. It's a precondition for growth and therefore for convergence. To the extent possible, it avoids creating distortions, making the economy less efficient, disincentivizing investment and therefore growth, productivity growth, that preserves fiscal sustainability, and that preserves the proactive fiscal policy that has characterized Lithuania, at least since the GFC. And remember, you are in a currency union. So that's a rigidity, a big rigidity that your economy has. You need to compensate that, and fiscal policy, in terms of policy tools, is the main policy tool available for macroeconomic stabilization, so this is important. Of course, you can choose extreme solutions. You can accommodate all spending with higher revenues. After all, your revenues are lower than in Scandinavia. Well, you could do that, but the increase in revenues would be so much that probably you would create more distortions, because some taxes are distortionary. You would reduce potentially the attractiveness of Lithuania for foreign investments, so you could affect private investment and potential growth. You could alternatively say, okay, let's do nothing and increase debt, accommodate with higher deficits, but then you will put in question fiscal sustainability and therefore macroeconomic stability, and you would weaken your fiscal position, and therefore fiscal policy will not be able to play an active role to support the economy in bad times and rebuild buffers in good times that has characterized fiscal policy in the last few years. So you have a big challenge, as a country, and it's to find the right balance between all these objectives, all these goals, and at the same time accommodating this spending pressure. So what do we think could be a reasonable mix of solutions? What are the tools you have at your disposal to address this and at the same time try to preserve these goals? One is there needs to be, it will have to be some pension reform, some parametric pension reform. Your pension system, it's benefiting from better than expected dynamics in the labor market, higher labor participation, higher employment in the short term with high wage growth. But aging is kicking and kicking quite significantly. This year is the first one that the new retirees will exceed new members of the labor force, and that's only accelerating going forward. And in 2026, the extension of the retirement age stops. Those two will put pressure on Sodra, and so the deficits, the surpluses that now Sodra experiences will be shrinking and becoming deficits at an increasing pace, especially after 2026. So what are the challenges you have? Well, let me make a side comment here, because we understand there has been a constitutional court ruling on the second pillar, and that potentially will open the debate again about the second pillar. The second pillar is not the solution to the pension challenges. It's part of the solution, however. What is the pension pillar doing to your system right now? The pay-as-you-go component, the dark blue part, this is the replacement ratio, the ratio at which you get a pension relative to the wage at the time of retirement. The black part, the dark part is the part that current workers' contributions finance current pensioners. With a shrinking population, your labor force is going to go from 1.8 million to 1.3 million people until 2030. You will have a shrinking amount of workers paying a significantly increased amount of pensioners. So in a pay-as-you-go system, that can only happen either with massive transfers from the budget, that will be problematic from a fiscal point of view, or with inadequate pensions. What the Pillar 2 is doing is stabilizing that decline. And so it doesn't increase the replacement ratio, but it prevents it from falling. In orange is those who did not opt to enter into the Pillar 2 will not do that, and will have, yes, now they are getting an extra part of their salaries coming to them. They are not contributing to the second pillar, but they will get significantly worse pensions going forward. So what is our view is that Pillar 2 is part of the solution, that it should be strengthened, it should be stabilized, let mature, give predictability so people, compliance and participation increases. Participation should definitely be encouraged. Non-participation creates a big problem. And withdrawals, we understand it's not constitutional to prevent withdrawals, but they should be very discouraged or should be very limited if possible. So some reform of the pension system will be necessary. Healthcare and education are examples of areas where funding could be increased, but there is an efficiency gain. So given the funding you currently have, if you compare to peers in Europe, your outcomes are poorer. So there are efficiency gains that can happen. It's very difficult to quantify if these are large or small, but you can do better with the same amount of resources. And in an environment where spending pressures are so large, this is also, should be also part of the solution. And again, Serhan will expand on this afternoon. But also, I mean, revenue mobilization is inevitable. It's difficult politically, and the previous government, the current government, have all tried some form of tax reform that has proven very difficult to approve, but it has to be part of the solution. And your revenue, if you look at the difference with the euro area at the right, it's what, 9 percentage points of GDP, 8 percentage points, around 8 percentage points lower. It was higher in 2019. It's 1.3 percentage points lower now, so your revenues as percent of GDP have increased. In our view, your tax system depends overwhelmingly on indirect taxes through VAT and on labor taxes through contributions. So ideally, those are areas where the extra revenues should not necessarily come. Your corporate income tax is low, creating an attractive environment for foreign investment. There is some potential there. Your real estate taxes are low. There is some potential there as well. And obviously, environmentally related taxes. Those are also possible and will also address the environmental externalities. Now, different options here have different implications in terms of economic efficiency. Some taxes are more distortionary, some taxes are less distortionary, but there is also a different impact on distribution. Some taxes affect low-income households more than other taxes. So those are all considerations and trade-offs you will need to address and understand before. But there is a potential to increase revenues while keeping a relatively competitive economic environment. And finally, you had as I said before, you have a very strong and proactive fiscal policy that has proven to be very effective for Lithuania. Now, your fiscal framework right now was discussed and designed after the GFC, when you were a currency board. Now you are a euro area member, a member of a reserve currency. So you are, in some aspects, you are an emerging economy, but at the same time, you don't suffer the biggest challenge of emerging economies, which is to manage capital flows, especially in times of crisis. In times of crisis, the euro is a reserve currency, so you will benefit from the stability that provides. So there is room. Your rule right now, the constitutional component of your rule, will force, once the output gap becomes positive, to move to a structural balance or surplus. I mean, again, we think that a strong fiscal position that delivers a proactive fiscal policy is necessary. But you can achieve that with not such a strong fiscal position. So here we just provide the trade-off of, if you, a structural balance around -1% will deliver a debt level that is below 40, between 35 and 40%, and will give you space to provide fiscal support in downturns without breaking the Maastricht criteria of -3, and will therefore also allow you to rebuild buffers in good times. So there is some room to not have to move to such a strong fiscal position, also because the fundamentals of the economy and the fact that you belong to the euro area also suggests that you don't need such a strong levels of fiscal strength. But again, beyond this, it will threaten the stabilization role that fiscal policy plays. So as Serhan will discuss, we have a table with all possible options and highlighting some of the possible trade-offs. I'm not going to get into it, but this goes over the 4 areas where the solutions should come. And it analyzes what are the measures, what is the potential impact, and also the trade-off in terms of economic efficiency and distortions, and in terms of distribution. And I think I've gone a bit over time. I apologize, Simonas.
Right. Thank you. Borja, if you don't mind, I think we can move on to the panel discussion, and we will have a chance for a Q&A at the end of it. So please welcome to the stage our distinguished speakers, Ms. Gintarė Skaistė, Mr. Gediminas Šimkus. Borja Gracia is already here, and the panel will be moderated by Vaiva Šimkus, Head of Macroeconomics and Forecasting Division at the Bank of Lithuania.
Good morning. Does that work? Yes. Good morning, everyone. My name is Vaiva Šimkus. I'm the head of macroeconomic forecasting at the Central Bank of Lithuania. And today we gathered here to hold a panel discussion on competitiveness. Lithuania, like many countries, has faced significant challenges over the last few years. After demonstrating resilience during the pandemic, the economy was hit hard by the energy shock, which was triggered by Russian invasion into Ukraine and subsequent sanctions. Since 2022, we have seen subdued income convergence, muted GDP growth, negative productivity, as well as some loss in market shares, as we have seen in the presentation before. Compounding these recent shocks are long-standing structural challenges, such as demographics, limited capital deepening, as well as inefficiencies in labor markets, in education, and in healthcare. These developments have raised concerns about the competitive position of Lithuania and its potential for growth in the future. So before we begin today, I would like to go over some housekeeping items. Our panel discussion is going to take for 1 hour. At the end of it, we will leave 10 minutes for the questions from the audience. I would like to kindly ask you to keep your questions brief and to the point so that we can take as many as possible. I also need to inform you that Governor of the Central Bank, who is one of our distinguished guests today, will not be able to answer any questions regarding monetary policy decisions or macroeconomic forecasts. This is due to the quiet period which will last till the Governing Council meeting next week. So we are honored here today to have 3 distinguished panelists who will provide us with a comprehensive view on Lithuanian export performance, productivity growth, challenges ahead, and strategies to enhance competitiveness on the global stage. So please join me in welcoming our panelists. I will introduce them once more. Mr. Borja Gracia, the head of International Monetary Fund Mission for Lithuania, Mrs. Gintarė Skaistė, Minister of Finance for Lithuania, and Gediminas Šimkus, the Governor of the Central Bank of Lithuania. So without further ado, let's start our discussion, and I would like to address the first question to Mr. Gracia. As you've shown in your presentation, and as we know from the previous IMF research, Lithuania has demonstrated a strong growth in tradables productivity growth, sometimes even higher than in other Baltic countries. What is your assessment? What caused this really strong growth? What are the reasons behind of strong growth in Lithuania in manufacturing sector?
Okay. So I'll focus particularly in the period post-GFC, where really it's when productivity and the tradable and the growth was led by increase in export shares and external competitiveness. I think what has happened since then, just to contextualize, is that productivity, the link between productivity and wages has been strong and what the theory predicted. So you've had significant increase in real wages, but that was supported by productivity because at this time you were increasing the market share. It's difficult to pin down why, and especially because when you start thinking of the reasons, some of them also apply to Estonia and Latvia. So, but let me highlight a few, and I'm not going to provide a comprehensive answer. But first, I think to the starting point, the GFC and the very significant performance since then. When Lithuania entered the GFC, the economy was going under significant imbalances. but they were the smallest of the Baltics. Yes, the current account deficit was 10%, but in Estonia it was 15%, in Latvia it was 20%. Yes, the savings of the private sector, non-financial corporate, was very large, but in Estonia and Latvia, also the household sector, before the GFC, the savings rate was very negative. And in Lithuania, really, the household sector only joined the party the last 2 years before the GFC. But before then, there was not. If you look at balance sheets, the deterioration of the balance sheet, the net financial asset position of non-financial corporates in Lithuania was the best. I mean, the deterioration was not as large as in Latvia and in Estonia. So the starting point was relatively stronger balance sheets, and the behavior of wages and productivity since then suggests that the labor market in Lithuania was able to a larger extent, to determine wages at the firm level. And so the link between wages and productivity has been very important, and wages have not deviated from productivity. Now, this is important because Lithuania has, when we look at manufacturing, goods exports, one of the highest share of, I mean, it overwhelmingly depends on low-tech manufacturing goods. I think it's the, if not the lowest, second to lowest in the euro area, more than in Estonia and Latvia. So price competitiveness for that part of manufacturing is more important. And so the fact that wages were still linked to productivity, it's important because your wage level it's obviously, for those goods, is lower. It's also true that we are talking about growth, productivity growth and wage growth, but also the level of productivity was lower. So part of that higher growth is also reflecting catching up. That in Estonia, for example, the starting point in levels was higher. So.
Thank you for this very extensive answer. So I would like to invite you to move to the most recent shock now. Russia's war against Ukraine resulted in sanctions against Russia and Belarus, and in a actually significantly stronger price shock in Lithuania compared to the Eurozone average. Minister, I would like to pose this next question to you. How has this situation and this shock affected Lithuania's exporters' performance and competitiveness? Have they been able to find new markets, new suppliers?
Maybe I would start from the political answer, because I think that the question is wrong in many reasons, because I don't think that sanctions are hurting our economy. Putin's war is affecting our economy, and the sanctions is one of the weapons to fight the Putin's war, and without sanctions we couldn't do that so effectively. So I think that sanctions are inevitable, but they are inevitable just because of the war. So it's maybe a starting point that not the sanctions itself are hurting the economy, but the main reason is Putin's war, and without Putin's war we wouldn't have sanctions and wouldn't have the impact that we are having. So the main reason is, anyway, it's a war. And looking at the consequences of this war, maybe there are two tracks. One track is when we're looking at the exports to destinations like Russia and Belarus. They were affected, but I don't think that they were so important at the end of the day, just because if you're looking not at the bare numbers of exports to Russia and Belarus, but to the number of goods of Lithuanian origin, that's the main issue. Because if you're just re-exporting the goods from different member states to Russia and Belarus, it doesn't make such a big difference to our economy. So if you're looking just at the goods that were produced in Lithuania, the bare numbers were pretty low. So before the war, the exports to Russia was around 2%. Now they decreased to lower than 0.5%, and if you're looking to the Belarus, before the war also the numbers were around 0.5%, now it's 0.25%, so it's pretty low numbers, and the direct impact from the lowering exports to those destinations, I don't think that we are affected very much our economy. But the main impact came from the energy crisis, and I think that in some part of the crisis we were prepared. We were prepared because of a long-term strategy. We did had the different possible ways to get the energy through LNG terminal, through the links to Poland and Sweden. So we did have possibility to buy energy goods from whatever, not from Russia, and that gave us a possibility be the first country to stop buying energy goods from Russia after the invasion. And I think that was important for our resilience. But at the same time, we just understood that we are very, very dependent on the imports of energy. And if the prices in international markets increased very sharply because of Russia's actions in the gas market, which affected the electricity market, so the prices in Lithuania increased very sharply. And we were among the countries which were affected one of the most in Europe, I would say. And that gave us also the push to make additional decisions in making our resilience and electricity in energy markets more ambitious. And now we have a lot of new projects and a lot of ideas how to increase our resilience, investing into the additional generation of electricity from renewables, and I think it's really important. Our ambition now is to have in 2027 100% that electricity that we need inside the country, produced inside the country, and I think that will make us more resilient. We do not have gas, we do not have oil, but we have sun, wind, water, so we can be like an independent island in the terms of energy. And I think that's really important. But to the final point, the energy crisis affected all the countries in Europe, maybe differently, but affected really hardly all the countries. And we are seeing that the prices of energy are decreasing after the invasion, and the prices of gas normalized. Maybe the prices of electricity are still a bit above the pre-crisis level. But if we're looking at the producer price index, if we took a basis of 2021, so now Lithuania's producer's price index stands at the same number as average European. So that means it affected us, but it affected us in the same in average, in the same way as all the other European countries are affected. Maybe it's not the same to the external competitiveness to the other parts of the world, but at least in Europe, the European average is the same number as in Lithuania.
Thank you. Governor, how do you assess the competitive position of Lithuania and the market share developments? What is your take on that?
Well, it's quite difficult now to add something after these two very extensive answers. But so I'll make a couple of remarks. Sometimes we refer to ourselves as a small and open economy. I don't like these words, not the words open, but the small. I like the word we are tight economy. And tight in many sense, because many things which is happening are basically, so to say, are happening in a couple even factories within the country. So, for instance, when Mr. Borja was referring to growth of the financial sector, growth of the exports of services, so there are very specific reasons, and even companies, why this business or why these services were growing that fast. For instance, last year. Getting back to your question on the competitiveness. Yes, last year we had a quite substantial contraction of goods, but according to our estimates, and we made quite extensive estimates that are published in Lithuanian Economic Review, very recent Lithuanian Economic Review published by the Bank of Lithuania, this is not because of the price competitiveness reasons, but because of the structural and some one-off factors. One of factors, so this largely refers to the re-exports
as Minister was pointing, this is Putin's war, which was entered by sanctions, but of course, in terms of EU exports, this led to the stricter trade controls on the third countries, and then eventually this had effect on re-exports to the CS countries. So, but I consider this as a one-off factor and not like something that's coming from the price competitiveness. Let's take another sector, for instance, wooden furniture that suffered quite heavily in recent years, or last year, and the year before. Yes, the exports decreased, but this was happening because of what was happening in the overall real estate sector, not only in Europe but worldwide. It was shrinking, it was sluggish. Therefore, the need for specific, so to say, items, for instance, furniture or some other wood items, was declined. So we had the overall, so to say, decrease of exports, but this was structural. It was affecting everyone, and we didn't see that we are losing market share. And actually, Mr. Borja was also showing a very interesting chart where you split the decline in exports into demand factor and competitiveness factor, and that was very specific Lithuania, which was basically coming from demand. Two-thirds or 3/4 of it, and not the price competitiveness. So, long story short, we do not, so far at least, we do not see the loss of competitiveness of Lithuanian exports, and of course, it's very much depend on the evolution in the future.
Indeed, so we see that the competitive position of Lithuania is quite good so far. So, Mr. Gracia, could I ask you if you see anything special about Lithuania in the past that allowed to absorb the significant input price increase and to some extent limit the decrease in market shares?
So, let me first mention the terms of trade shock. So when I showed annual numbers, so it was average over the whole year. But if you look at monthly data, the terms of trade shock deterioration in Lithuania was at the worst 20%. In Latvia and in Estonia, they were basically almost zero or very small negative at the worst situation. That implies that the pass-through of, but for all of them, import prices, they were all subject to the increase in import prices. It was slightly larger in Lithuania. The price of import increased around 45% at the worst, 40 in Estonia, 35 in Latvia, or close to. Or so that explains part. And Sayo in her presentation will go into the details why the price of import was more pronounced, but I think you also addressed that in Lithuania. But the economy has been very dynamic in absorbing that and adjusting to that already. So if instead of looking at terms of trade coming from price of export and imports, which at the end is a survey of representative exports and imports and their prices and evolution, but we look at what it's called, I think, unit value indices using custom data, very high frequency data, and it's like it controls for price effects, but also for volumes, for quantity effects. So it will show an economy that is adjusting to the change in relative prices. We see that creating a similar terms of trade measure using that and adjusting for the quantity impact, we see that in the case of Lithuania, the terms of trade suggests the worst was a minus 20% impact, but this it's less than half, minus 8%, and it's very similar, 6 and 4 for Estonia and Latvia. So the economy already adjusted to that. Now, how could companies in Lithuania have much less pass-through of import prices than in Estonia and Latvia? Part of it is that coming out of, so into 2022, before the war, the corporate sector in Lithuania looked particularly strong. In our, there are several reasons. First, as I mentioned before, it was already strong traditionally, but COVID had a less of an economic impact in Lithuania. excluding Ireland, which is very particular because it heads these global companies, Lithuanian economy was the best performer of the euro area in 2020. So the impact of COVID in economic terms was not as big as we expected. But the fiscal support then exposed, one could argue, was disproportionate. Obviously, at the time, the uncertainty was so big that it was adequate. But that meant that, for example, in our estimate, the strength of the balance sheet of the corporate sector was stronger in 2021 than it would have been without COVID. And that manifested in historically high liquidity, as you can see in deposits at the banks, which still is the case. An increase in profitability in 2020 and 2021, that is very clear, and it was also very high by historical standards. The net financial asset position reached the best in recorded since we have data. And so those all were buffers that corporates could use to absorb part of that import shock without having an impact on, without having to pass through to exports. Also, as I showed, the fact that nominal wages did not increase, were negative, I mean, were below inflation, was also a margin that allowed, helped the balance sheet of companies not to have to pass through as much. Now we are observing that real wages are increasing, and now it's profit margins that is absorbing the current shock, and it's still, the disinflation is still being, it's still underway. But I think that helps explain why companies in Lithuania could absorb the import price shock.
Thank you. So indeed, companies were able to absorb the significant shock. However, nevertheless, more recently, we have seen the decrease in productivity growth. And I would like to turn to you, Governor, now and ask, how do you assess this most recent decline in productivity? According to your assessment, is it more of a structural or cyclical nature?
Well, when you see the declining productivity, so it's always, you know, something which is worrisome, and whatever the economists will eventually say, if it is for structural or cyclical, the decline in productivity of the economy is something that you don't like. So that's like the general remark, and then this is mostly about the future. So you ask yourself, is this short term or is this long term, and how this will end up in the overall development of the economy. So far, I dare to say, so far, we think, we evaluate that this is because of the that this decline in productivity is of cyclical nature, and there are a couple of things which let us think in that way. First of all, this is the employment, this is the labor market. I think it's still kind of a not sufficiently recognized fact that the labor force, even with this, so to say, sluggish economy in the recent 2 years, the labor force increased to the levels which were pre-EU accession. And that's substantial, because typically we talk about shrinking population, aging populations, etc., etc. Second is that unemployment rate, as it was shown again in the chart, is one of the lowest in the last 25 years. So this labor force was employed. So companies keep those people working, even if average hours worked per employee are lower than they used to be before. So this phenomenon is called labor hoarding, but it's happening. The question is why? If companies would have believed that this is long-term decline in productivity, do you think they will, so to say, risk their profits and keep those people employed? I think the obvious answer is no. So there is a kind of a belief within the industry, within the economy, the businesses, that this is short-term decline. Second is that the other factor that helped the company, so to say, to accumulate or or that build the capacities. Of course, this is the overall financial stance, as Mr. Borja was explaining, is better than in the pre-COVID time. But actually, the profits in 2022 were elevated in the businesses. And with the real wage growth being negative or subdued, this made the labor force relatively cheaper than other production costs. And the final point, why I do still think that productivity decline is cyclical, this is the investments. Again, if you don't believe in the recovery of the economy, in the recovery of the demand of your production, so you would not have made the investments into the expansion of businesses. Last year, total investments and private investments, non-residential, I stress here, are highest since the global financial crisis. So for me, all this creates the environment in which I can say in business there is a belief of a temporary decline in productivity, and I see them preparing for a spring once the demand, external demand in particular, comes back. And the second and the last thing, I don't know if this is the right in the right place in terms of or in sequence of a question. We too little talk about the, and that's what I can't pronounce, but I'll try, entrepreneurship of Lithuanian economy and Lithuanian businesses. It's high. And that's the third reason I believe that the decline in productivity is temporary.
Thank you. Again, a very extensive answer to the question. Would the other panelists have anything to add on how worrisome could be the recent downturn in productivity?
I think that the main debate about productivity is when we're starting to debate about the wage growth, and especially when we're starting to debate about the minimum wage level. I just want to say that we have seen the wage growth rate in Lithuania around 9% in the recent decade, for 10 years already, from 2016. And every year we have the same debate about is it the dead end or we have to do something. So from my perspective, what is the final goal we're looking for? Is it competitiveness itself, or do we need the healthy, rich society, and competitiveness is just a weapon in the fight for that? So in my opinion, yes, the rich society is the final goal. And we must look at all components of the competitiveness just because we need the rich society. So wages itself cannot be the thing we're fighting against. So we're fighting for the high wages, but we have to have a stable economy to reach that. So I would say that in the recent 3 years, the wages grew by double digits every year. So, and every year we have the same debate about competitiveness. And I still think that the Lithuanian economy is healthy and we can absorb such a level of the wage growth until this moment. Yes, we have to invest a lot into our productivity, but at the same time, the wage growth is also one of the drivers of the investment into the higher productivity. Because if you're feeling that you're paying too much for your workers, you have to have additional value from the same labor force. So I would say that at this moment, so we are seeing that the investment, as the governor said, at a pretty high levels, and the firms are investing into the higher productivity. And maybe to the final point, that where do we need to be competitive? That we need to be competitive where we are competing. So we are competing in their external markets. And as Mr. Borja said, in a tradable sector, more or less competitiveness and productivity are more or less in line with the wage growth. So I would say that our external competitiveness is at a healthy level precisely now, but we should not sleep at this moment and do our job to keep investment high and to keep our competitiveness at a healthy level.
Let me just a couple of points. We have a similar assessment. Just in the last point, our assessment the last few years has been that in exporting sectors, the wage growth has been consistent with productivity, and that has high productivity, and that therefore has supported high wage growth at the same time as you were gaining export share. So on the labor hoarding, we also have the same. If I can just go on a bit of details why we think that is happening, partly the governor mentioned it. The expectation is that this is a temporary shock. So you don't react with drastic employment decisions if it's a temporary shock, especially because there is a scarcity of skilled labor, and particularly because the issue of skill mismatches in the labor market, and the issue of there is a mismatch also of what the skills that the especially tertiary education system produces and the labor market demands, means that the labor force it's scarce for companies. They invest in firm-specific human capital. And so if the shock is going to be temporary, firms will hold to skilled labor, will reduce the intensity of the labor. So it's almost an automatic, it's not really real productivity that this is showing. And then we also expect that, particularly in manufacturing, where this is more the case, the recovery will come without a strong employment increase, because first it will increase the intensity, the use of intensity. Having said this, in the fund we are paid to worry. So I would have to say, yes, it's largely cyclical. We expect the labor productivity to pick up as the recovery gains pace, but there are several buts. And it's the world, once the situation normalizes now, is not the world pre-war in Ukraine. Geopolitical risks are higher, particularly in this region. Interest rates are going to be higher for a while. And in Lithuania, you are impacted by both the perception of risk that is higher in this region and the higher policy rate. So the cost of capital is going to be higher than it used to be for quite a few years. Beyond the region, there are fragmentation risks going forward. World trade has seen a significant integration over the last few decades, but there are some question marks about the increasing fragmentation in the world that will, if they materialize, or depending on how fast and how strong they materialize, will have an impact on total factor productivity around the world. And we were saying part of the reasons why firms were able to absorb this shock is buffers that they have used, but then eventually they will have to rebuild to address the next shock. So those buffers are not exhausted, but are reduced. All those factors are challenges that were not there 2 years ago, but are there now. So my bottom line is, we cannot just, I mean, there is a need to continue support this productivity growth. I guess we will have an opportunity to discuss that further in the panel, but to support, because at the end, the only way to support high wage growth in a sustained way over time eventually has to be through higher productivity on the sectors where you compete.
Indeed, thank you for those three answers to this very important question. I would like to go back a little bit now to the labor market. And indeed, we have seen very strong nominal wage growth in the recent years. And as we've seen in the presentation, we are seeing real wage growth recovery already. And if we look into the future forecast, we are likely to see quite significant real wage growth in the future as well. So I would still like to discuss a little bit about this risk. How worrisome is that, and how it could affect the competitiveness of Lithuanian exporters? And on a related matter also, maybe what the state should do with the minimum monthly wage, for example.
I've said everything what I think about the high wages. The minimum wage, yeah, we have that debate every year, and we have different decisions made in the past. But at the present moment, I just wouldn't like to intervene a lot, just because we have the procedure when the Bank of Lithuania, they're suggesting the number according to the formula that was previously used. And we have the trialogue between unions, businesses and government, discussing about all the outcomes that might be after the decision will be made. So I would say that we still expect the agreement between these three parts, and if they will agree on something, last year they agreed on a certain number, so we are the ones who will implement it. But if there will be no agreement, I think we will look at the numbers of the labor force, of the economic growth perspectives, about productivity, competitiveness, and the government will make the decision together with a process when we will prepare the budget for 2025. But at the present moment, we still wait for the agreement, because I think that social dialogue was really important when you can hear all the arguments from different sides, and to have your informed decision if there will be no agreement. So they're still in a process.
So the wages in Lithuania in the last decades are growing by almost 10% on average. And when I say this to my fellow colleagues at the other central banks, they are shocked. That's substantial growth. We need to admit that. According to our March projections, wages this year will grow by another 10%. And the productivity declining last year, and the project, according to March projections, to increase by almost 2%, growth of unit labor cost will decelerate, but will be substantial, 7%. So what to do, the question is. And then I think we always try to compare us to this golden average, which is EU average. So we are definitely approaching EU average according wages, but there's a gap. There's still quite substantial gap. And this gap is bigger than the labor productivity gap to the EU average, even if it is closing step by step. Okay, then why we are surprised by all this? We joined the EU for what reason? To compete being cheap labor country? Or we want, as Minister said, welfare and well-being, rich society. So if you want to live as in Switzerland or any other, as in Spain, you need to have an economy functioning more or less at those levels as those economies. If you want to compete with countries where textile industry is dominant, well, we shouldn't talk about high wages then and wage growth. So we shouldn't be surprised by the rise of unit labor cost eventually, because it's inevitable. It's a process of convergence. Having said all this, we put so much emphasis then on price competitiveness and too little on non-price competitiveness. And the richer we become, the non-price competitiveness factors become important. And Mr. Borja was mentioning skills mismatch. We could have better, so to say, system of education, aging society, many of these structural factors, but they are very important if we think of ourselves in 20 years from now or even more. And I think this non-price competitiveness targets, goals, are a bit out of the agenda, of the political agenda, but they should get there. If we want to, so to say, if we want to live as any other rich country, you should think what those countries are doing and move to the business or countries model, economy model as well, on minimum wage. Here in the country, we talk that much how minimum, or by how by how much the minimum wages should increase next year. And by this, we lose the, so to say, the oversight, why this minimum wage is growing. And minimum wage is set in various countries for different reasons. In one countries, where you have like 80% of population working for minimum wage and high unemployment, I mean, you just control, you know, the overall level of wages in that economy. Is that the case of Lithuania? No. I can't show you the chart, which is one of the best, in that respect, charts produced by the Bank of Lithuania. Sorry for promoting the bank. But it's the chart that shows how the wages are evolving over the year in different deciles of or categories of people by wages. So what we clearly see, that wages in this economy, in these countries, are growing, no matter if we increase minimum wage or not. So increase of minimum wage is a must to catch up the growth of the average wage in the country. Why? Otherwise, you will have a certain percent of the population which is working for minimum wage, which is not growing because they are vulnerable part of our society. And very much agree with the minister who says that, I rephrase it a little bit, this is a measure of social policy rather than, so to say, setting the wages in the country as such. And my colleagues at the Bank of Lithuania made a very extensive research on the subject. And what we clearly saw that from 2010 to 2019, the increase in minimum wage shrunk the income inequality by 1/3. And this effect became even stronger when minimum wage started growing faster. So, as I said, I believe that I look at the minimum wage and its increase from the perspective that this is the measure of income inequality reduction as a measure of social policy. And yeah. So.
Thank you. Moving forward and now looking into even further future, Mr. Gracia, I would like to give a word to you now. Could you reflect a little bit on the factors that could lead to a structural increase or decline in productivity?
I can't resist making a comment on minimum wages, sorry.
Of course.
I wanted to provoke you.
After all, it's the last time I'm coming in my official capacity, right? So, no, just to say, in Lithuania, when you look at, for example, the impact of fiscal policy in terms of redistribution, we haven't looked at the numbers lately, but when we look at that, the main tool for redistribution is the pension system. So there is this, it's true that since then, this was probably 2018, since then, social spending, social programs have increased significantly and they have become more targeted. So maybe the component of redistribution is different. Now it seems that since you don't have a very strong fiscal policy in terms of redistribution, you use other tools like the minimum wage. I'm not sure if it's the best, most efficient tool to reduce inequality. And I just want to add a couple of points of skepticism of some unintended but not unexpected consequences of minimum wages that are high relative to average wages. When you look at the impact of the minimum wage, it's true that the incidence, how many people are at the minimum wage, is relatively small. Depends on the region, depends on the sector, but it's not significantly high. If you look at the minimum wage relative to the average wage, not at the aggregate level, which is the way it's determined, but either by region, by economic sector, or by age of the employee, there is quite a strong correlation, which correlation is not causation, but there is a strong correlation between the minimum wage to the average wage in each of these subsectors or components and the unemployment rate. I think the minimum wage sometimes, especially if it's discussed in Vilnius, it tends to underweight the potential impact at the margins that in regions with much lower average wage than the national, or for sectors of the economy or ages of the workers, that impact can be much bigger and can have a very distortionary impact, and it would be on those that need more to be employed, and the impact would be obviously higher unemployment in those sectors. So that's where. So our point, we understand that there is a legal constraint in you cannot have minimum wage in a discriminatory way by regions or by ages, but we understand also that it could be possible to have it by industry, maybe different minimum wages depending on the industry. Or now at the European level, there is a proposal to start linking also minimum wage to some measure of productivity. Now, the discussion is starting, but I think those would be steps in the right direction. Going back to your question, as I said before, there are some characteristics of Lithuania is that in terms of manufacturing, you have a high share of low-tech manufacturing exports. On services, it's the opposite. Or at least the growth in high-tech services has been really what it's been driving that sector. So let me I think Sayoa will cover this in more detail, and actually one paper that it's coming from Serhan, it's on the drivers of productivity growth. There are some factors that are positive in the case of Lithuania. For example, obviously, the level of productivity is still far from the frontier, and so you will benefit from being able to adopt technologies and that are already there, and so being your productivity level being low in a way allows you to have higher productivity growth to catch up because adopting new technologies. Also, investment in ICT, information and communication technologies, seems to be correlated to higher total factor productivity growth, and that's particularly where investment in the last few years, the last 3 years, has been the second highest in the euro area. Again, from a low level, but those are. But I think the governor was right. There are non-price competitiveness, other factors, the business environment, the regulatory environment. Definitely the labor market is very flexible, but there are still structural issues, the high skill mismatch, the education system. Really, we hear that it's not just not widespread, but not also that anecdotal that people with tertiary education then have to go into vocational training. So you have invested money and effort and resources and years at the prime age of people that then acquire some education that it's not demanded in the labor market. All those factors definitely need to contribute. But if I may also step back, because I've always felt that in Lithuania you have like a not very optimistic perspective of yourselves, whether the previous performance or future one. One of the things why we wanted to show this longer-term perspective of performance is if in the next 15 years you perform like you have performed in the last 15 years, your convergence will continue. So it's not that you are a success story. Of course, you are still below the European average. Still a lot of convergence in the wage levels, in price levels. But I think I'm going to use some cliche formulas, but there are two that come to mind. One is, I think it's in the medical profession, is do not harm. First, do not harm. Well, there is a success so far. Let's just make sure that whatever you do going forward doesn't eliminate the factors that deliver that success. And the other, which is related, is this thing of if it ain't broken, don't fix it. So things don't seem to be fundamentally broken, definitely, because there has been a success. And what are some of those are more qualitatively. But I think one of the lessons in Lithuania was the GFC was an opportunity, a crisis that was used as an opportunity. Your framework improved significantly. I talk about your fiscal framework. That has been a source of stability that has been very important. Labor market flexibility, with all the shortcomings we've just discussed, has been very important. The firm level termination of wages has been very important to support this performance. You need those flexibility from fiscal policy and the labor market because you don't have it in the exchange rate. You had a framework that, in terms of economic policy, I've been coming 7 years, as you mentioned, with the previous government, with the current government. In many countries in Europe, you observe that the first thing a new government does is undo everything that the previous government did. And subsequently, these governments do the same. Here in economic policy, there is a broad consensus. Of course, every government has different emphasis, but there is an overall consensus and continuity. So there is a lot of predictability in the policy, and that provides a lot of stability. Those are Euro area membership. Also, it's very important source of stability. In terms of the policies, your macroprudential framework has been very proactive, and again, you need that because you are an open economy, a tight open economy, but you are subject to all shocks in the world because you are very open to the world. And so all those should be preserved. And so anything you do, I don't think you need to do reactionary policies. Things seem to be working reasonably well. So the first thing really going forward is to build on that success.
So, risking to be a little bit pessimist again, I will ask Governor now whether you see some challenges which could actually lead to that structural decline in productivity or maybe lower growth in the future.
Depends what you consider as future, short term or long term. I very much agree on the short-term factors. There are many things that are underestimated, and I think in the IMF presentation we've seen it quite obviously. Aging demographics, for instance, skills mismatch in many sense. Again, this was touched upon, and the other thing, we lack investments into innovations. Yes, we are proud of the fintech hub or being a fintech hub country, but this is one specific, so to say, field of the economy. What about the others? What about the investments into research and development? What about the private and public sector collaboration on innovations? Because this is something which is done in the economies which is of rich people and rich society. So these are, I think, these long-term factors which need to be taken account. I think it's much easier to say than to do, because problems are typically solved when they appear. And even if strategically one could elaborate how we should, so to say, take everything into account, what's 50 or 100 years ahead, we fight with climate change. I think this is the obvious example how short-term view of people can predominate. But getting to, so to say, to a shorter perspective, and even if I discussed that decline in productivity is cyclical and short-term, maybe temporary, but if the subdued demand continues, I would consider this as a risk to our productivity. We live in very uncertain times. We still project, according to our March projections, the recovery in the economy this year and even more next year and the year after. But in these uncertain times, in many cases, projections, they were not, so to say, exact as the reality was. So I would still consider that there is quite substantial risk of the subdued demand, and this then eventually, if it takes longer than expected, we talked about that companies keep people, they invest, but if something goes wrong, and the economy became sluggish for too long, it is a risk for productivity.
Thank you. Yes.
Should have said, and the words of the governor remind me, I think all the micro elements and all the investment, I fully agree. But the biggest challenge in the next 5-10 years is really how to address those spending pressures. Because at the end, a lot of the decisions that will be made will determine whether that macroeconomic stability, fiscal sustainability, predictability, all those things, depending on how to address and when to address those. So that's the biggest challenge. And that will determine a lot of how the business environment, the predictability of policies and things, and all that. Obviously, with elections in October, it's the challenge that the next parliament and the government that comes out of that election will have to face. But it's going to be only an increasing problem. It's already felt, and it's been accelerated because of defense and interest expenditures, but it's only increasing over time and at an increasing pace.
As we're moving closer to the end of a discussion, and we already delved in, already a little bit into the strategies and policies which work and we should not change them, I would like to address this probably last question to you, Minister, to expand a little bit on those policies which has worked in the past, which should be pursued in the future in order to increase productivity, in order to achieve a resilient economy in the future, having in mind all those challenges we have discussed here, short-term and long-term.
If we talk about something what was in the past, I think that yes, Lithuania is a success story and our growth was impressive from the accession to the EU. And part of that success was a prudent policy of Lithuanian policymakers, but at the same time the prudent policy of the businesses of Lithuania. Because if we have a lesson, we learn a lesson. And if we had the Russia crisis, we have annexation of Crimea, the exports to Russia decreased dramatically, and we do not depend anymore on the Eastern markets. The main markets for Lithuania, 61% for Lithuanian origin goods, it's European Union. 9% it's US, and 5% and more is UK. So 75% of our Lithuanian good exports is to predictable markets, and that's important. I think that gave us strength and more predictability in everything we're doing. Another strong point for Lithuania is our prudent policy in the energy sector. We do not have a reliance on deliveries of energy goods to Lithuania, and that's also the success story. Another success story that is still waiting us is growth of the renewable part of the energy, and then we will be independent from the imports of energy from the other countries. That's something that makes us resilient. If we're talking about growth and growth of the productivity of Lithuanian labor force, I would say that the main question is maybe physical capital, human capital, and also innovation. So when we're talking about the investment level, so we're trying to use prudently our European funds, so 8 billion from 21-27 perspective will come in Lithuanian economy, 2 billions this year. And also recovery and resilience funds, 2.2 billion from subsidy side, 1.7 billion from the loans. And one of the newest measures that we're doing, it's 1 billion for businesses from the same recovery and resilience fund loan. We are making the loan measure for the businesses that are tended to grow. So they are big businesses, but they're innovative, they're green, they are digital, so I think that's the main weapon we can give them to grow, because they have all the reasons why they are growing, but at the same time they have a lack of capital, and that's where we can help. Also, we made a major reform during this our government term, so we are consolidated 4 national development institutions that we had previously in Lithuania. So now we have one strong development, not bank, fund institution, but it's really important that we gave them muscles, we gave them capital, we gave them additional funds to give the loans to businesses, and I think that will make the impact, especially to the businesses that are they have capabilities to grow, not those who are weak, but for those who are strong and might be stronger. So I think that's really important. And human capital, yes, it's also one of the questions that are tough questions and difficult to answer. And the answers that you are making will make the impact not tomorrow, not the day after tomorrow, and not even in 1 or 2 or 3 years. So it is really difficult to make a difference difference when the actual outcome will be much later. But I think our government made a lot of in all the levels of education, and the education levels which sometimes we do not think about, for example, like preschool level kindergarten, accessibility to kindergartens, which make a huge difference when we're talking about the productivity in the longer term, because these people who are attending kindergartens, their gains in a long-term perspective, they are much higher. So all these reforms, they are giving the effect, but it will not be very fast. Also, the schools reform via Millennium Schools program, also vocational education now reform is made, also higher education reform. So a lot of reforms which are not very popular, but at the same time the impact of it will be later. But I think that those are the steps into the right direction, and I think they will make the impact in the longer term.
Thank you all for those insightful and thought-provoking contributions. And we have covered a lot of ground, and I'm sure that now the audience must have some questions which panelists would be happy to answer. Yes, please.
I'm Marius Kalanta from the Institute of International Relations and Political Science. First of all, thank you for the presentation and for the discussion. These were very interesting and useful. I have a question about the structural features of the economy. Structurally, the Lithuanian economy is dominated by low technology manufacturing and less knowledge-intensive services such as transportation services. These sectors, and structurally the economy probably has some ceiling for productivity and wage growth. How high the ceiling is in your opinion? And a brief second question is, these cyclical developments you have all described and mentioned, what pressures these developments can exert on structural changes, because these structural changes, as we so far see, hasn't changed much during like recent decades. So we have like quite stable structure of the economy. So thank you.
So it's true that manufacturing has a very large share relative to other European economies of low-tech technology, low-tech sector. It's also true that the economy, as part of the convergence stories, the share of manufacturing is shrinking and the share of services is increasing. And the good part is that the increase in the share of services is mostly in the high-tech part. Now, one point I didn't mention when we were talking about the pass-through on export prices is that the fact that there is, on goods, this low-tech manufacturing is a sector that depends more on price competitiveness. And that also explains why companies needed to absorb the price shock more than, for example, in Estonia and Latvia, where the share of low-tech manufacturing is low, and therefore they don't depend as much on price competitiveness, right? But the trend of the structural transformation is happening. And actually, for example, you can also see in the employment share. Services is increasing the employment share, manufacturing is decreasing the employment share. And so I think that is happening as you would expect in a gradual way for a converging economy. It's also true, and we look at this actually during COVID, that shocks, big shocks that hit manufacturing tend to accelerate that transformation, in the sense that, for example, in the labor market, shocks that hit the sectors of the economy that are decreasing their labor share, there is a further decrease in employment beyond the trend that it's never recovered. So it accelerates that process. That's why, but one special fact of COVID was that in relative terms, it was manufacturing, which is normally the sector most affected in big shocks, was the least affected during COVID because it was the essential sectors that were never locked down. And so that transformation didn't accelerate then. Let's see what has happened after this episode. Maybe what we will observe out of this is a slight acceleration of that shift, the structural shift in the economy, which is something that we could predict. But at the same time, and contrary to other crises in the past, we've argued the labor market has performed particularly strong. So maybe this time around that has not happened. But the expectation is for that to continue with cyclical variations, but really the trend has been there for a long time.
Very good question, but I think you asked this in a very deterministic way. What are the ceilings for wages given the structure of the economy? But this, we are bounded by the territory and most likely by the amount of people we have, and we agreed with, we have aging population, so it's already a fact. So there are some, so to say, predetermined factors that will affect the evolution. He has stressed the word evolution of our economy, but the economy itself will evolve. Therefore, I'm not that much afraid of the increase of minimum wage, because with the growth of wages, this makes the factor to make a change to our economy, not by the government or by institutions, by the businesses themselves. For instance, according to the OECD study, risk of automation is in Lithuania is one of the highest. This means you could look at this from the positive and negative side. So there are plenty of opportunities to automate businesses and to arrive at a higher productivity in those businesses. That's good. On the other side, we have one of the highest mismatch between needs in industry and labor force. And the people laid off from those businesses that started automation, what are they going to do with those people? If we keep wages low in the country, so most likely they will be hired by the companies which produce lower value-added production. But if we think that increase of wages and automation moves the economy itself into the production of higher value-added production, I think this is how the economy could evolve. And here, as I said, we are living in bounded country, like territory, bounded by number of people, etc., etc. This means it evolves. Evolves means that you have something new, something growing, and something, leaving the market. There's going to be bankruptcies, but this moves into a higher level of the well-being of society. So therefore, you ask a deterministic question, but I can answer. It's infinitive. My answer is infinitive. Wages grow with the growth of the economy, with the changing economy. If it doesn't change, most likely we're going to see the limit. But I'm optimistic about the economy itself.
We are a little bit behind the schedule. Maybe one last question. Yes.
Yes, of course.
Hello, Eglė Kučionytė from the Research Center of the Bank of Lithuania. I have a question to Mr. Gracia about essentially the firm dynamism role on competitiveness. In the last year, there are a couple of raw facts. So last year, the number of bankruptcies in Lithuania increased by 20%, more than 20%. And also, there was a record number of businesses registered, probably the highest in the last 2 decades. What are your thoughts on these channels? Do you think they are important for increasing the competitiveness of the Lithuanian economy? And are we exceptional in this way, maybe compared to some other countries?
So I just linking to what the governor just said, there will always be bankruptcies, and because the economy is evolving, is converging, so there will be industries that are that are not viable anymore because of loss of price competitiveness if they were depending on that. So that is not uncommon. Now, the issue of bankruptcies, we need to be careful because in 2020, in some cases, it was actually not possible to issue, to register bankruptcy. So, but in general, COVID basically reduced the number of bankruptcies across countries, particularly also because companies that were going under difficulty, whether for COVID or non-COVID, but were supported by the public sector. So we actually look at this from a balance sheet perspective, the transfer of losses from the non-financial corporate and households, but in this case, non-financial corporate to the public sector across Europe was very large. And that helped, and that and administrative constraints on actually being able to issue bankruptcies meant that the number of bankruptcies fell significantly in 2021. Now, the fear when the economies reopened was whether once they reopened, a lot of companies were going to go bankrupt. Again, from the macro level, we observed that since the losses from the private corporate sector had been transferred to the public sector from an aggregate balance sheet perspective across Europe, you didn't see that. The balance sheets were actually strong. In general, at least they hadn't deteriorated, and in some aspects, particularly liquidity and leverage, they had increased. They have improved. And that's what happened, really. So what I think the increase last year, it's largely due to a base effect, a low base effect 2 years ago, rather than a structural issue that is happening. Now, when you have a flexible economy, it's the same with the labor market. In a flexible labor market, there are a lot of new entrants and new exits. So there is a lot of people that lose their jobs. If that's the only thing happening, that's a problem. But if at the same time you have a dynamic economy that adjusts quickly to changing economic developments, you also have a lot of new jobs created. And I think that is the two sides of the flexibility. So I don't see necessarily the issue of you can have both, no? A large amount of bankruptcies, but new firms registering. As I mentioned before, using the unit value index, it seems to suggest that the economy in Lithuania, the corporate sector, tends to adjust quite quickly to big shocks, and in this case, to a big relative price shock. And that's good, but that will manifest itself into a lot of new entries and a lot of exits.
As we draw this discussion to an end, I would like to give a special thank you to our panelists and to audience for your excellent questions and your active participation. To wrap up, it seems that Lithuania once again has demonstrated its ability to be resilient amid significant shocks. And let's not forget what helped us to be resilient before and to have the same energy and capacity to navigate between those structural shocks in the future. Thank you again.
Thank you very much. So we will now have a coffee break. Coffee is at the back of this room, and we come back at 11:20 for the following presentations. Thank you.